Last month, I went over an all-stock portfolio, and before that, we discussed Harry Brown's permanent portfolio. We examined how both stacked up in terms of long-term growth, managing economic downturns, and achieving financial independence. What we found was that those two strategies lie on seemingly near opposite ends of the investing spectrum, with the permanent portfolio handling downturns pretty darn well, but struggling when it came to long-term returns and sustaining someone's lifestyle once financially independent, while the all-stock portfolio had very strong long-term returns, but a lot more volatility. This week, we'll be splitting the difference between the two and examining an investing strategy that seeks to find a balance between those solid long-term returns and having reasonable amounts of volatility. Let's talk about the classic 60-40 portfolio.
But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today.
So similar to the all-stock strategy, the classic 60-40 strategy can take on many forms. The basic idea behind it is to split your money up between stocks and bonds, with roughly 60% of your money being invested in stocks and the other 40% in bonds, though some people do choose to use different percentages depending on their investing goals. This is just the most common split. The reason to do this is pretty simple. We love the long-term growth prospects that stocks provide us with, so we don't want to ignore them entirely with our investments. But at the same time, we hate the volatility that comes along with them, so we don't want to overload our portfolio with them either. The returns of bonds have historically been uncorrelated enough with stocks to provide that balancing out effect reasonably well, while allowing us to capture most of the overall returns of an all-stock strategy. But as you can imagine, there are numerous ways that you can split up that 60% in stock and 40% in bonds. You could invest in individual companies, sectors, or even countries within the stock market. And you could choose to invest in government bonds or corporate bonds or even some sort of inflationary bond. The possibilities are seemingly limitless. But to keep things simple for today, I'm going to be assuming that we simply invest all our money into a total stock market index fund for the stocks and a total bond market index fund for the bonds. With that being said, let's start by analyzing the historical long-term inflation-adjusted returns of this strategy. To analyze those returns, we'll be looking at a few different metrics. The first and perhaps biggest is the 40-year inflation-adjusted returns for every year starting from 1927 through the end of 2019, since again, that's the last completed year I have available to me at the time of this recording. We'll also be taking a look back at how many times the portfolio lost money and how severe those losses were in comparison to the permanent portfolio and the all-stock strategy. Ideally, if this portfolio is doing its job, we should see that it comes to somewhere in between those two more extreme strategies for both returns and volatility. Finally, we'll touch on how dependable or trustworthy the strategy is by examining how sensitive those long-term returns we're seeing are to when we decide to start investing. So based on the data I have, since 1927, the average 40-year inflation-adjusted return for the classic 60-40 strategy is about 5.1% per year. Its worst-case return was around 3.6% per year, assuming you began investing in 1939 or 1940. Its best-case scenario was an average return of around 7% per year, assuming you began investing in 1980. That suggests that a $10,000 investment would grow to, on average, $73,000 over the course of 40 years after adjusting for inflation. At worst, you're looking at a nest egg of around $41,000, and at best, almost $150,000. Compare this to the all-stock strategy, which had average, worst, and best returns of 6.5%, 4%, and 8.9% respectively, and the permanent portfolio whose returns clocked in at 3.4%, 1.4%, and 5.1% for those same categories. So by the looks of things, the classic 60-40 strategy is, on average, splitting the difference between the two pretty well. Next, let's look at some volatility metrics. The average standard deviation of returns for the classic 60-40 strategy was 11.9%, which means that on any given year, we can expect that most of our returns will fall somewhere between negative 6.8% and 17% with this strategy. That is a wider margin compared to the more tranquil permanent portfolio, which had a standard deviation of just 8.6%, but it is significantly narrower of a gap than the one we saw with the all-stock strategy, whose standard deviation was around 18%. And just like with any of these strategies, there will occasionally be a few exceptions where the returns fall outside of our expected range, for better or for worse. Generally, more tranquil portfolios like the permanent portfolio will have fewer of these instances, where the more volatile strategies like the all-stock approach will have a few more. The classic 60-40 strategy falls in between these two extremes, just as we would suspect. Looking at the individual returns of each year in our return diversity chart, we see that roughly 68% of them, or 63 out of 93, fall within our expected range. That is a fair bit below the 82% of returns that we saw falling within the expected range of the permanent portfolio, but it is above the 60% we saw with the all-stock strategy. There was a total of 26 years where the portfolio failed to keep pace with inflation in this sample. That's a loss frequency of around 28%, which is slightly worse than the 27% we saw with the permanent portfolio, but it is a decent bit better than the 32% we saw from the all-stock strategy. Thankfully, like most of these strategies, the majority of those down years were recovered from reasonably quickly. There were a total of 7 10-year stretches where the strategy failed to keep pace with inflation. They were the 10-year stretches ending in 1975 and 76, 1978, 79, and 80, in 1982 and 83 when inflation was very high, but unlike the all-stock strategy, it did manage to eke out small gains throughout the new millennium in spite of 2 major market downturns. The all-stock strategy posted 3 more 10-year stretch losses for the stretches that ended in 2009, 2010, and 2011. Interestingly, it managed to match the permanent portfolio in this metric, which also had 7 such 10-year stretches where it failed to keep pace with inflation. However, most of the permanent portfolio's losses came in the late 1940s and early 1950s. So numerically, they were roughly equal, but they specialized in slightly different ways. The permanent portfolio had access to gold, which was going absolutely bonkers through much of the 1970s, but it was less successful in the 1940s, largely because the price of gold was being artificially kept stable, and that played a large role in the difference in the outcome. Next, let's talk about start date sensitivity. Start date sensitivity, at least as we're measuring it in this series, takes a look at the rolling returns of the 10 years prior to each initial investment date and compares it to the rolling returns of the following 10 years to see how big of a difference there is between the two. It's a good way to get an idea of how dependable or trustworthy an investment strategy has been historically. And ideally, we want to keep our total start date sensitivity, measured here by the difference between the largest underperformance and the largest overperformance, as low as humanly possible. The permanent portfolio handled this very, very well, with a total start date sensitivity of 16.4%. The all-stock strategy, as you would expect, was less dependable. Its total start date sensitivity came in at around 35.4%. Once again, the classic 60-40 strategy splits the difference between the two reasonably well, with a total start date sensitivity of 23.6%. The largest overperformance was 12.5% per year, which took place from 1982 to 1992. In those years, the classic 60-40 strategy had an inflation-adjusted return of 11.1% per year, beating out the returns from 1972 to 1982 of negative 1.4% per year. The largest underperformance was negative 11.1% per year, when the returns from 1999 to 2009 failed to match the returns produced from 1989 to 1999. But that just about wraps up the analysis of this strategy's returns. Now let's move on to our crash analysis. A crash analysis is always important to do for any investing strategy you're looking at, because it's important to know that if you're going to put your life savings into something, that you'll be able to weather the storms when they come, both financially and otherwise. In these videos, we look at a few different metrics when analyzing the crashes. They are how deep the crash got at its worst, how quickly the strategy typically recovered from said crashes to reach new highs, and the Ulcer Index, which largely combines the other two metrics into a single number. Interestingly, despite the large amount of stocks in this portfolio, the deepest crash wasn't the Great Depression. That's thanks in large part to the bonds doing their job of balancing out the volatility of stocks to some degree. The deepest crash for the classic 60-40 strategy, and the longest one for that matter, was actually the crash of the mid to late 1970s. From the highs set in 1973, the strategy would fall almost 37% when adjusting for inflation by 1975, before beginning a slow climb back up to set new highs by 1984. So it was down for around 10 years. Now remember, inflation was going kind of nuts at the time, so much of that inflation-adjusted fall is the inflation itself, as opposed to the actual price of the investments cratering like we saw with stocks during the Great Depression. To give you an idea, the CPI, or Consumer Price Index, which gives us a general measure of inflation, was around 42 in 1973. It jumped some 22% to over 52 by 1975, and continued on to reach 102 by 1984. So of that 30 37% drop between 73 and 75, only about 15% of it was the fall of the investments. The rest was inflation. I only mention this because we're using the CPI to estimate inflation in this series, but not everybody's expenses are going to increase at the same rate as the CPI. Some will become more or less financially efficient, or have shifts in priorities as time goes along, which may shelter them from some of the effects of inflation or exacerbate them. It's just something to keep in mind as this series goes along, is all I'm saying. The ALSR index during this time period rose to as high as 2.0, which is actually dead even with the worst we saw from the permanent portfolio, and much, much better than the 3.5 we saw from stocks at their worst. However, similar to the other strategies, for the majority of the 93-year span, it was much lower. On average, it hovered around 0.6 or 0.7, which is not quite as steady as the permanent portfolio's 0.4, but it is much easier to stomach than the all stocks 1.4. So as you can see, both from a long-term returns perspective and in harder times, the classic 60-40 strategy has historically done its job of balancing out risk and reward far better than either the all stock or permanent portfolio strategies did. That doesn't make it objectively the best strategy for everyone, but it does show how it's a solid middle ground between the other two extremes. With that being said, let's move on to examining the strategy in regards to financial independence. And here's where things get a little bit interesting. To this point, we've established that the classic 60-40 strategy is a fairly solid middle ground, at least between the more tranquil permanent portfolio and the powerful all-stock strategy. We do continue to see that pattern play out in the accumulation phase, but in the drawdown phase, it actually starts to shine brighter than we might have expected, particularly in worst-case scenarios that most of our retirement rules of thumb are based on. Historically speaking, the classic 60-40 strategy would have maintained minimum safe withdrawal rates of 3.98% over any 30-year stretch, 3.73% over any 40-year stretch, and 3.56% over any 50-year stretch from 1927 through 2019. The worst year to retire using this strategy was, without question, 1966, as that's the year all of these minimums were set. And I should note that, as usual, due to the varying nature of individual expense ratios and tax situations, neither has been considered in these withdrawal rates. The median rates were a bit higher, at 6.12%, 5.23%, and 4.81% for the 30, 40, and 50-year scenarios respectively. And the maximum rates for the same durations were 9.6%, set in 1982, 7.69% set in 1980, and 6.83% set in 1949. The strategy would have maintained a minimum perpetual withdrawal rate of 3.28%, and as usual for this series, I'm defining perpetual withdrawal rate as the highest withdrawal rate that you could have had while still maintaining your original principal all the way through to the end of the dataset after adjusting for inflation. So if you had $1 million in your nest egg when you settled down in 1927, which would have been a lot then, but still, that perpetual withdrawal rate would still leave you with at least $1 million worth of buying power by January 1st, 2020. In raw dollar terms, it would have been something north of 20 million because of inflation, but that's basically what we're saying here. I hope that makes sense. So while the median and maximum withdrawal rates are in between the permanent portfolio and all stock strategies as we would expect, the minimum and perpetual withdrawal rates are actually the best of the three. This is, again, as a result of striking that balance between the rewards of high returns from stocks and the risks of volatility. The accumulation phase of financial independence is where you're still putting money away for your future. The primary metrics here is what percentage of your income you're saving, how do your expenses change over time, how long do you plan to be retired, and how long will it take you to reach FI based on that information and the performance of our investing strategy. Assuming that our expenses change at the same rate of inflation, which is what we're assuming in this series, and we were planning on a 30-year retirement, while saving a fairly standard 15% of our income using the classic 60-40 strategy, we would have reached financial independence in just one of the 93 scenarios. That singular success was the very first one in 1927. And it took the full 93 years to achieve, which is not great. Now obviously, as I've stated in previous videos in this series, we don't expect a 100% success rate with any of these accumulation tests because that suggests that someone investing 15% of their income starting in 2020 would reach financial independence in 2020, which is just not realistic. But still, given how long of a time frame we're looking at, I would have hoped to see more than one successful scenario. With a 30% savings rate, the numbers do improve with a hypothetical investor reaching financial independence in 26 of the 93 scenarios, which is every scenario from 1927 to 1952. On average, achieving FI with this strategy at this level of savings took about 69 years. The fastest was 35 years starting in 1927 or 1930, and the slowest was 81 years starting in 1933 or 1934. With a 50% savings rate, the numbers improve with a hypothetical investor reaching financial independence in 69 of the 93 scenarios. On average, achieving FI with this strategy and at this level of savings took about 33.5 years. The fastest was just 18 years in 1948, and the slowest was 51 years in 1945. And finally, with the absolutely crazy 70% savings rate, the numbers improve even further, with a hypothetical investor reaching financial independence in 84 of the 93 scenarios. On average, it took about 14.5 years, with the fastest being 7 and the slowest being 28. So as you can see, while the classic 60-40 strategy doesn't have the best long-term returns, it does still manage to post reasonably solid gains with considerably less risk than something like the all-stock strategy does. In that sense, it's a much better bang for your risk-adjusted investing buck, even coming close to the permanent portfolios in areas of risk and volatility. And in addition to that, it manages to hold up pretty darn well in the worst of scenarios once you're financially independent, even if its best-case scenarios are not quite as strong as the all-stock strategy in that area. So where does that leave us? We've done a few videos now in this series, and while the all-stock strategy did make some pretty impressive headway when it came to accumulating enough money to reach financial independence, at least based on the models we're using, it still did need 30 or so years to do it, especially in those lower 15% savings rate scenarios. We also saw that people investing in something like the permanent portfolio may have never achieved financial independence under a 15 or even a 30% savings rate scenario. Does this mean that financial independence is likely out of reach for those of us who aren't willing to pour our entire nest egg into the stock market or have ridiculous levels of savings? What if we're not 20-something anymore and therefore have less time to accumulate wealth? Are we screwed? Well, as it turns out, no, and thank goodness for that. What we do have to keep in mind when dealing with any financial modeling, including the stuff that we're doing for this series, is that the assumptions used in the models don't always necessarily reflect our own personal situation. No matter how much thought and effort went into the models, there's just so much variance in everybody's situation. When it comes to the financial independence model we're using for this particular series, perhaps one of the biggest assumptions is that our expenses will increase each year, forever, in line with inflation, which is measured by the CPI. And as I touched on a few minutes ago, that isn't always going to be true. We can learn to become more financially efficient. We can better understand our wants and needs, prioritize them to our liking, and get more out of what we already have. Eliminating that financial waste can free up a surprising amount of cash in many cases. Vicki Robin, who's done a lot of work, of course, in the realm of raising financial awareness and eliminating financial waste, says that in her experience, most people she's seen go through this process see their total expenses cut by 20 to 25%. Say you're taking home $60,000 a year and living on $48,000 a year now. Assuming you're investing the remaining $12,000 or 20% of your income, and you go through this process to eliminate any financial waste you may have, you're probably going to achieve a few things. First, you'll increase your savings rate immediately, which is not accounted for in the model. Just to make the math easy, let's say you eliminated 25% of your expenses after going through that process. Well, now you're spending $36,000 a year and saving $24,000 or 40% of your income. And as we know, that improves your chances of not only reaching financial independence, but doing it quickly by quite a substantial amount. And again, it's not being taken into account in this model. Second, you'll lower your financial independence savings goal. Again, potentially quite substantially. Take the permanent portfolio as an example. It had a 30-year minimum safe withdrawal rate of 3.15%. At $48,000 a year in expenses, that would suggest that you would need roughly $1.52 million put away to be considered financially independent. At $36,000 a year, that goal drops all the way down to $1.14 million, which is still a lot, but it's quite a bit easier to handle. And the difference becomes even more substantial the longer your potential retirement is, since those minimum safe withdrawal rates tend to be a little bit lower for longer retirements. Which means that for those looking to retire early, these things are even more important to take into consideration. Third, and another thing this model also doesn't take into account since it's more focused on trying to isolate the effects of specific asset allocations for educational purposes as opposed to creating personalized financial plans, is that going through this process may lead to you totally resetting your inflationary spending curve. If we assume a 3% average rate of inflation, it would take a full 10 years for you to get back to spending $48,000 a year again in the scenario that we just laid out. And fourth, of course, is that the CPI may not accurately capture how your spending changes over time. Perhaps there's some things in the CPI's formula that drags its numbers up or down that you simply don't spend money on. That could further throw this model's inflation assumptions out of whack, either in your favor or not. And fifth, there's nothing saying that you can't use one strategy during your accumulation phase and a different one once you've reached financial independence. I know several people who have done that. And sixth, we're also not accounting for the fact that most people's spending actually drops when they first retire, simply because they're often not having to pay for those work-related expenses anymore. But anyway, you put all those things together and you'd see a serious jump in the success rates compared to what we're discussing in this series, as well as probably a quite serious drop in the time it takes to reach financial independence as well. So no, the numbers we're discussing here in this series doesn't suggest that we're screwed. What it does do is really drive home the importance of some of the other topics we've been discussing on this channel for the last 4 or 5 years. The importance of practicing frugality, managing your burn rate, and if possible, maximizing your income. All these factors matter when it comes to giving yourself the best chance to reach financial independence with a lifestyle that you love living.
But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.